Welcome! Today we're mastering pullbacks, the secret to smarter entries, tighter risk management, and long-term profitability. A pullback is a temporary move against the prevailing trend before that trend resumes its original direction. In an uptrend, think of it as a short-term decline. The market is taking a breather before continuing higher. In a downtrend, a pullback is a short-term rally or relief move before the price continues its slide lower. Many traders lose money because they chase the price after a strong move, buying at the peak due to FOMO. Pullbacks offer a second chance. They allow you to enter at a much better price with significantly lower risk. Let's look at an example. Imagine an index climbs from 20,000 to 20,500. It looks incredibly strong. Instead of buying at the top, you wait. The price pulls back to 20,300, hitting a key support level. The trend resumes and moves to 21,000. By waiting, you've secured a much more profitable entry point. This leads to our first major benefit: smaller stop losses. This is the foundation of professional risk management. When you enter after a pullback, your stop loss can be placed just below a support level or a swing low. At 2,300, your risk is only 100 points. If you chased at 2,500, you'd be risking 300 points for the same protection. Smaller risk leads to a better risk-to-reward ratio. This is where the real money is made in trading. Without a pullback, you might risk 300 to make 600, a 1-to-2 ratio. With it, you risk 100 to make 700, a 1-to-7 ratio. Pullbacks also reduce emotional trading. They force you to trade with discipline instead of excitement. Remember, the best traders often get paid for their patience and their ability to wait for the right setup. Let's compare two traders. Trader A chases price. They win 60% of the time but only have a 1-to-1 risk to reward. Trader B waits for pullbacks. They only win 50% of the time, but their risk to reward is 1/3. After 10 trades, Trader A is up 2 units. Trader B is up 10 units. Higher profit with a lower win rate. How do we find them? First, look for support and resistance. Previous resistance often becomes new support. Second, use moving averages. In strong trends, the 20, 50, or 200 EMA often act as dynamic floors for price. Third, look for a change of character, or choja. This confirms the pullback is ending and the trend is resuming. Finally, Fibonacci retracements. Institutions often look for entries at the 50% or 61.8% levels. A word of caution: not every dip is a pullback. You must ensure the overall trend is still intact. If market structure breaks, like making a lower low in an uptrend, it's likely a reversal, not a pullback. Here is your framework. Identify the trend, mark your key zones, and wait for the price to arrive. Look for confirmation like an engulfing candle or a rejection wick before hitting the buy button. Place your stop loss beyond the invalidation point and target the next major liquidity area. In summary, pullbacks give you better prices, tighter stops, and higher profitability. The trend is your friend, but the pullback is your opportunity. Subscribe to The Profitable Trader for more lessons on price action and market structure. See you in the next lesson.